perspective, want that upside. So I don't think they hedge that away, just in case you really get that pop. And then you get that one pop you're kind of hoping for, and then when you were fully hedged out on the price side, you kind of missed it, right? And so if you have institutional investors that are having that lottery ticket mentality, where they've only invested 50 basis points, 1% of their total AUM, they don't really care about sort of the 60 to 70% kind of pullback that we've seen this year. They're still kind of hoping for that 5 to 10 years out. So I do think that they are taking kind of directional bets. However, what I think the introduction of the derivatives market has certainly done is widen the investor base. No longer do you have to hold the underlying crypto to have exposure to the asset class. So I think that what it's really done is, yes, it may have added kind of a continuous selling pressure, but these are all brand new investors that have now kind of played around in crypto. These are not the same guys that have been playing in the space for 1 or 2 years. So I do think that it's been a positive for the space, certainly in that sense.
Great. And Tom, you recently put out a report, I think a few weeks back, talking about Metcalfe's law as a way to measure, a potential valuation for Bitcoin and other crypto assets, and you use that as a proxy for the network effect. So I'm just curious. You said it explains about 70 to 80% of the price change. And can you just talk to us a little bit about Metcalfe's law and explain what that is for the audience and how you use that to come up with potential valuations?
Yes. So Metcalfe's law refers to a study actually coined by Metcalfe. I don't know, it's Robert Metcalfe. He's a professor at MIT. But the concept actually belongs to George Gilder. So if anyone is old enough to know who George Gilder is, I'm impressed. He was a telecom guru in the late 90s, and he was postulating this idea that the value of a network is not a linear function of the user base, it's actually a log function. So if you double the user base, you actually have a 4x increase in network utility. Interestingly, social networks are really explained by this. So I'll talk about my presentation, but like if you looked at FANG and you didn't know the FANG business model, but you just bought FANG based on a belief that internet users globally would grow, you would have captured 75% of the return of FANG. You didn't have to analyze it. And so the idea is, these cryptos actually are explained by how many active users. And so we published several pieces on this, but the most recent one was we looked at the top 10 protocols, and the lowest explanatory value was 50%, and for Bitcoin it's over 70%. So the value of Bitcoin is basically explained by the community itself.
Yeah, and I think that has important implications for Ethereum Classic in particular because, as Anthony mentioned in his discussion yesterday, we're kind of seeing an increase in all of the various micro metrics that are indicative of the health and growth of the network. So certainly think that's interesting. Mike and Jack, I'm also curious to get your perspective on the trading side of things. So what are you seeing from the investors that you're servicing in terms of the types of signals that they're trading on, and are the majority of them long-term holders, or are they short-term active traders?
I think there's a range. I think the players who have been in the space for a while, they are obviously have a lot more crypto holdings, and they're looking to sort of sell at different points of time. And the ones that have taken the longest to convince to kind of come into the space, whether it's from several meetings or compliance or once you get comfortable around this, they actually come in and be very much a long-term holder, and they have a much longer-term perspective. And some of them, I feel like they feel that there was something missing about Bitcoin in their view, or something missing about Ethereum, and the new sort of protocols kind of capture their imagination. So you're actually seeing quite traditional VCs or traditional institutional investors take long-term bets on longer tail coins. Actually, that's a little interesting perspective I have. And obviously venture type. They can venture bet on some of these projects, and that's contrasting with sort of, again, the OG type of people who are very much hardliners towards Bitcoin Cash, Ethereum Classic, Zcash, these are the cool names.
Getting ready for this this panel, I was looking at some of our own trading data, trying to figure out some of the insights regarding ETC that we've seen at Genesis. And one of the interesting things that I was sharing with Matt earlier before we started this panel is that on the OTC trading side, it really has, the volume, the dollar volume that we've traded has really mirrored kind of the relative market caps between ETC and ETH. Almost scarily so. And where today you have ETC kind of sitting around 5-6% of kind of ETH's market cap, that is exactly roughly the ratio between ETC and ETH on the pure over-the-counter trading side. Conversely, Genesis is also the authorized participant for Grayscale's products, and dollars into the ETH trust is almost exactly the dollars into the ETC trust so far in 2018. So the relative market cap differential doesn't exist for the Grayscale products. So what does that mean for me? One, I do think that volume, liquidity, short-term trading mentality really does drive the OTC side, whereas the trust investors are certainly doing this for longer-term investment. And so whether or not that's because ETC holders are okay with the 12-month lockup and kind of longer-term investment horizon, or people just simply see ETH as a trading mechanism and are less willing to kind of invest it and kind of hold it in the long run. But I thought that was an interesting piece of correlation sort of being.
Or Barry's branding himself very well as an ETC supporter.
Yeah, I think, jumping to the next question, Tom, something that you and Sam Docker, I know, have also looked into is kind of the value mining cycle. What I mean by that is, it seems like, when ETC or Bitcoin's price goes up, you have mining capacity coming online, the difficulty goes up, but that can also unwind very quickly, which leads to sharp spikes in volatility. So what are your thoughts on the role that mining plays in market cycles? And is this a risk that investors are just going to have to accept because it's sort of the nature of the beast?
I think when you look at the security side of Bitcoin and the mining, it is really the most corporate, right? It's true profit incentive based. And I think in the downturn, I do believe there's a misconception. Large miners, when Bitcoin's price and Ethereum actually downturns, they're not necessarily net sellers. And we've talked to a lot of miners about this, that in general, because they know the ROI of producing a crypto coin, they'd rather hold it. But when prices are high, they actually tend to be sellers. So I think in a way, miners are actually acting as a stabilizer. They're not actually worsening what's happening in crypto. It may change when Beckb becomes available. They can actually do physical delivery. But the cost of mining actually is playing a role that most people don't appreciate. We're going to see it truly tested, but 2014 when Bitcoin bottomed, January 2015, it bottomed at 180. If you took the best GPU miner or ASICs at that time, the break-even cost for mining was around 180 to 200. So Bitcoin actually bottomed in 2015 at around 1 times mining cost. Today, that 1 times mining cost is around 6,000, and we've seen Bitcoin hold that level a few times. It's interesting.
Jack and Mike, do you have any thoughts on the role that mining plays?
I've watched keenly Tom's analysis on the mining cycle, and I tend to agree with it very much so. And I think one of the reasons we've seen the mining players looking to the capital markets to go IPO, a number of them, is we're creeping closer and closer towards sort of the break-even point for miners, which is maybe estimated at 5,000 US or so for Bitcoin. And it helps to have an outside balance sheet to kind of sustain yourself in the game. And if you look at how Bitmain kind of dominated the 2016-17 cycle, it's because during that downturn, 14-15, that's when they were able to continue to produce a better equipment, deploy more scale in the face of other miners not able to do so.
I think for us, we actually love it when miners are selling. Just having a natural seller every day is huge to sort of figure out your kind of daily flow. And so certainly for the coins that Genesis is making the market in, having sort of that natural seller every single day is